Hey everybody, this is another walkthrough lesson, this time on reversing entries. If you want to, I've left this worksheet up as a PDF file on the website. Print that out, pause this video, print that off, then come back. You can follow through with the video, okay, if you so desire, or you could just watch it. So if you want to, pause it now. Okay, great. Hopefully you're back and we can continue on with the lesson. So look, reversing entries have to be done, pardon me, to reversing entries have to be done to accruals. All right, now accruals happen at the end of the fiscal year as a part of the adjusting entries. And we're going to walk through two kinds of accruals that we've seen in the past, an expense accrual and a revenue accrual. All right, now the first example that we've got here is going to be on December 31st as our year end. And our accrual is going to be for some revenue that we earned on an investment. So the company invested $3,000 into an investment. On October the 1st every year, it pays 5% interest. Okay, at this stage, it should be pretty straightforward. October to December represents 3 months. You divide that by 12, you multiply it by $3,000, which is your capital investment, and then take that by 5%, and that gives us the paltry sum of $38. Okay, so our adjusting entry on December 31st will be a debit to accrued interest and a credit, pardon me, to interest revenue. Okay, $38, $38. Now down below here, you can see that I've got some T accounts set up for you. I'm just going to reproduce that entry here. So accrued interest is going to be our debit for 38 bucks. I'm going to make this number 1 just so we can keep things straight. And interest revenue is $38. Okay, that's pretty straightforward. We should all be pretty strong at that one. Now, the closing entry, I don't mean to confuse people too much, but the closing entry is going to be on December 31st. Actually, let me switch pen colors for this one. I'll go with red. On December 31st. Okay, our adjusting entry is going to be a debit to the interest revenue. Okay, because we need to close that account out for 38 bucks, and a credit to revenue and expense summary for $38. All right, and again, I'm going to reproduce that down below here. So what we're doing is we're debiting the interest revenue for 38 bucks, and this is entry number 2, just so we can keep things clear. And I'm going to make that a credit over here to revenue and expense summary, because that's what we would do at the end of the year on our closing entries. Now, it's important to note, and I'm going to make a note here, that this is a zero balance now. Okay, there is nothing left in the interest revenue account for the next year. Okay, now this is where the reversing entry comes in, and not only do I want to show you how to do the reversing entry, which is actually pretty straightforward, but I want to tell you why you have to do it. Okay, so I'm going to switch pen colors again, and I'm going to do a reversing entry and try to make my explanation pretty clear. Actually, let me go one step further, and I'm going to move up to October the 1st when we actually get the interest from this item. Okay, what we would do is we would debit or credit, sorry, interest revenue. Again, remember, I'm doing this on October the 1st. So I move way ahead of time, way past the year end, way past the beginning of the fiscal year. So it's a credit to interest revenue and a debit to bank for 150 bucks. Here's the problem. This $150 is not entirely correct because we've already amassed 38 bucks of it in the previous year. So we can't double count that $38, which is what we're doing right now. So at the beginning of the fiscal year, we have to reverse the fact that we accounted for this $38 in the previous year. And by doing so, what we're going to do is we're really going to make this 150 that we've just credited here less down to 112. Okay, so let me walk you through it. Okay, so on the beginning of the next fiscal year, which is January 1st, this is when you do your reversing entries. It's the very first day of the next fiscal year. What we're going to do is we're going to do the exact opposite of the adjusting entry. Okay, and I'll draw an arrow for that in just a second. Okay, so interest revenue and then accrued interest. Okay, that is $38 and $38. And here's what I'm going to do. Down below, I'm going to write this as number 3, journal entry. That's going to be a debit to interest revenue for 38 bucks and a credit to accrued interest for 38 bucks. All right. Now, notice what happens to the accrued interest account. That's zeroed out at the beginning of the next fiscal period. Done. It's gone. We don't need it anymore. Also notice what's happened with the interest revenue account is that I've debited it at the beginning of the year for $38. Well, when I credit it on October the 1st for the $150, the net total is $112, which is making sense, hopefully, because we've only earned $112 this year. We already earned 38 of it the previous year, and we're not double counting it. That's why we do a reversing entry, to make sure that we don't double count some entries. Okay? All right. Moving on. We're going to do the second one. This time we're going to do, which is another review of a accrual expense. Okay? So in this example, what we've got, pardon me, is a payment expense. So every 5 days, the employees are paid $1,000 for their work. The payday is Friday. The fiscal year ends up on Thursday, December 31st this year. Okay, so our adjusting entry is going to be pretty straightforward. Okay, if they get paid $1,000 every work week, they've worked Monday, Tuesday, Wednesday, Thursday, and Friday is the first day of the next fiscal year. So they're paid for these 4 days. We take 4 divided by 5, multiply it by 1,000, and we get 800 bucks. That should be pretty straightforward. I'm just going to go right ahead here and rush through this. This should be salaries, expense, okay, and salaries payable, all right, for $800 for each one. Okay, that should make perfect sense to you. And I'm just going to reproduce that down below here as well as an $800 debit to salaries expense and an $800 credit to salaries payable. All right. Now I'm going to switch my colors again. Let's make sure I'm going to go with the red for the closing entry. On December 31st, we have to close that account. Okay, so we have to debit revenue and expense summary. Okay, and then we have to credit salaries expense. Now, that would look like this in T account form, or in our ledger anyway. So 800 and then 800. Essentially making the salaries expense a zero balance. All right. Now, on the very first day of the next year, okay, here's what's going to happen. They're going to pay their employees $1,000. So that's going to be a credit to bank for $1,000 on January 1st. Okay, and it's going to be a debit to salaries expense for $1,000 on January 1st. Now, again, realizing that that's not exactly accurate because we've already paid them, or we've already expensed out $800 here of this $1,000. So what we need to do is we need to reverse what we did the previous year so we can accurately portray how much expense has been made already this year. So in, what color am I going with here? Green. Our reversing entry is going to be on January 1st. We're going to debit the, we're going to debit salaries payable. Because what we want to do is we want to reverse this and get rid of the payable. We're not going to pay them anymore. We don't owe them any money as of January 1st when we pay them. And then we're going to credit the salaries expense. And I forgot to mention this before with the revenue account. That is counterintuitive because we don't typically credit expenses. And just like in the last example, we don't typically debit revenues. But for reversing entries, we do for the purposes of accurately portraying the financial data that we're trying, the financial transaction that we're trying to get through to. All right, so in our ledger accounts below, we're going to debit salaries payable, which makes this a zero balance, which should make sense because we don't owe them the money anymore. And then we're going to credit expense for $800, realizing that this $800 is a credit, and when you net it out with the $1,000 debit, you only owe, the expense is only $200, which is 100% accurate because we've already expensed $800 of it from the previous year. Okay, guys, hopefully that makes things a little bit clearer. I again apologize for my really bad handwriting. Hopefully it's not too bad. Actually, it doesn't look too bad from here. If you got any questions, let me know. Make sure you do the practice exercise at the bottom. Oh, one last thing about the practice exercise. All that they really ask you to do is to take the adjusting entries here, okay, and turn them into reversing entries. Right? That's all they're going to ask you to do. I thought it was worthwhile to walk through and do the entire example just so you understand exactly why we're doing it. All right, but all you're really going to have to do is take your adjusting entry here and turn that into your reversing entry. And again, once you notice, they're the exact opposite of each other. In the adjusting entry, we debited accrued interest and credited interest revenue. In this example, the reversing entry is just the exact opposite. We debit interest revenue and credit the accrued interest. Okay, like I said, I'm online if you got any questions. Yeah, have fun. Thanks, guys. Bye.